50 years of history just sent a warning, and almost no one is paying attention. Twice before, gold collapsed by nearly a third, and twice before it came back stronger than anyone expected. Right now, we are standing in that exact same window again. The charts are lining up, the timing is lining up, and the number waiting on the other side of this correction is one most investors haven't even considered. By the end of this video, you will know exactly how long history says this takes, and exactly what could happen if this pattern repeats one more time. Welcome back to Precious Metals Intelligence, the channel built for investors who study history before it repeats itself. If you're new here, consider joining us, not for entertainment, but for the kind of long-term economic clarity that protects real decisions and real capital. And before we begin, we'd genuinely like to know, where in the world are you watching from today? Drop it in the comments. This channel has viewers analyzing markets from every continent, and it's worth seeing how far this reaches. Every long-term investor eventually faces the same quiet fear. The market they trusted turns against them, and the silence that follows feels louder than any crash. This is the story of gold and silver right now. Prices fell, confidence shook, and most people watching simply stopped paying attention, assuming the worst had already happened. But history tells a very different story, and it is one that very few people ever take the time to study. For 50 years, gold and silver have moved through the same repeating cycle. They rise, they peak, they fall sharply, sometimes losing a third of their value in a matter of months, and then, after a period of pain and doubt, they recover. Not immediately, not without fear, but they recover and they eventually climb to levels higher than before. This is not opinion. This is not speculation. This is a pattern written directly into the price charts going back decades. And when analysts study these patterns closely, they find something remarkable. Corrections in gold and silver are not random. They follow a structure. That structure is built on two forces working together, price and time. Price tells investors how far the market has fallen. Time tells them how long the recovery is likely to take. Most people only focus on price. They watch the number drop and panic. But professional analysts know that price alone is only half the story. Time is the other half, and it is often the part that gets ignored. To understand where gold and silver are headed next, analysts look backward. They study previous corrections, moments in history when gold or silver fell sharply, just as they have now. Two periods stand out above all others. The first is the 1973 to 1976 correction. The second is the 2008 financial crisis correction. Both moments caused serious fear among investors. Both moments felt at the time like the end of the bull market. And in both cases, they were not. What makes these two periods so important is that they represent two very different kinds of recoveries. One was fast, one was slow. One was driven by extreme conditions rarely seen in modern markets. The other closely resembles the environment investors are living through today. This is where the real analysis begins. If today's correction behaves like 2008, history suggests the recovery could happen in a little over a year, perhaps a year and a half. If it behaves more like 1973, the timeline stretches out much further, closer to 2 or even 3 years. The difference between these two outcomes is enormous, not just in time, but in how investors should think, plan, and act during this period. Understanding which pattern applies is not just an academic exercise, it has real consequences. Investors who assume the worst may sell at exactly the wrong moment, walking away right before a major recovery begins. Investors who assume too much too soon may become impatient, expecting a rebound that has not yet arrived. Both mistakes come from the same root cause, not understanding the relationship between price and time. This is exactly why history matters so much right now. The current correction in gold has already lasted close to 6 months, and prices have fallen by roughly a quarter to a third from their peak. These numbers are not unusual. In fact, they closely match early stages of both the 1973 and 2008 corrections. The real question is not whether gold and silver will recover. History strongly suggests they will. The real question is how long this specific recovery will take, and which historical blueprint the market is quietly following beneath the surface. Business professionals, long-term investors, and anyone paying close attention to economic cycles now stand at an important decision point. Do they interpret this correction as fear or as a familiar chapter in a much longer, well-documented story? History does not offer certainty, but it does offer probability, structure, and a way to measure risk instead of guessing blindly. In the next part of this analysis, the story turns to 2008 in detail, the correction most closely resembling today's environment, and the timeline it suggests for gold's next major move. What happened during that period may hold the clearest blueprint yet for what comes next. There's a reason experienced analysts keep returning to one single year when they study gold. Not 1980, not 2011. The year is 2008, and it may hold the closest blueprint for what investors are living through right now. To understand why, it helps to step back and remember what 2008 actually felt like. The global financial system was under extreme stress. Banks were failing. Stock markets were collapsing. And in the middle of all that fear, gold did something that confused many investors at the time. It fell too. This surprised people because gold is often seen as a safe haven, a place investors run to when everything else is falling apart. But in the middle of the 2008 crisis, gold dropped sharply, losing close to 30% of its value in a short period. Investors who had trusted gold as protection suddenly watched it fall alongside everything else. Fear spread quickly, and many people sold, believing the safe haven had failed them. What happened next is the part most people forget. Gold did not stay down. It began to recover, slowly at first, then with increasing strength. Within about a year and a half from its peak, gold had not only recovered its losses, but broken through to new highs. Investors who panicked and sold near the bottom missed one of the strongest recoveries in the metal's modern history. Those who understood the pattern, and who were patient enough to wait through the uncertainty, were rewarded significantly. This is why 2008 matters so much today. The current correction in gold shares several important similarities with that period. The percentage decline is close. The overall shape of the fall and early recovery looks similar. And importantly, the broader economic backdrop shares some resemblance as well, with uncertainty in financial markets creating pressure across multiple asset classes at once, not just gold and silver alone. Analysts studying this relationship point to a specific historical marker. If today's correction continues to follow the 2008 pattern closely, gold could be positioned to reach new record highs within roughly a year to a year and a half from its recent peak. This is not a guess pulled from nowhere. It is based on measuring the actual number of months it took gold to fall, stabilize, and then climb back through its previous high during that earlier period, then applying that same time frame to the current situation. Of course, no two market cycles are identical. Even when a pattern lines up closely, small differences matter. In 2008, the extreme stress in the banking system played a major role in driving investors first out of gold, then eventually back into it as a store of safety once panic subsided. Today's environment is different in some ways, shaped by different economic pressures and different investor behavior. This means the 2008 comparison should be treated as a strong guide, not a perfect promise. Still, the value of this comparison should not be underestimated. Financial history rarely repeats in exact detail, but it often rhymes closely enough to offer real, usable insight. When a correction today shares the size, shape, and speed of a well-documented correction from the past, it becomes a powerful reference point for anyone trying to make sense of what might happen next. For business professionals and long-term investors, this raises an important and uncomfortable question. If gold has followed a very similar path to 2008 so far, and if history holds even loosely, then the sharpest part of this correction may already be behind us, not ahead. That is a very different reality than the one being felt by many investors currently watching prices and assuming the worst. This does not mean the recovery will be smooth, fast, or free of doubt. In 2008, most investors did not believe a major rebound was coming until it was already well underway. The recovery unfolded quietly, without headlines, celebrating it in real time, and many people only recognized it in hindsight. That is often how major turning points work. They rarely feel obvious while they are happening. In the next part of this analysis, the story shifts to a very different chapter in gold's history, one that stretched on far longer and tested investor patience in ways that 2008 never did. Understanding that period is essential because it reveals the other possible path this current correction could still take. If 2008 offers hope, 1973 offers a warning. And any serious analysis of gold and silver has to include both, not just the comparison that feels more comfortable. The correction that began in 1973 was different from anything gold experienced in 2008. It was slower. It was deeper in some ways. And most importantly, it tested investor patience for a much longer stretch of time. Where the 2008 recovery took roughly a year and a half, the 1973 correction and its aftermath stretched across several years before gold fully broke through to new highs again. To understand why this period behaved so differently, it helps to look at what was happening underneath the surface, not just in gold, but across the broader financial system at the time. The early 1970s marked the end of a long and difficult period for stock markets. Investors had lived through a brutal multi-year bear market in equities, one that had worn down confidence across nearly every sector. As that bear market in stocks finally came to an end, something significant happened. Large amounts of capital that had been sitting in gold, used as a shelter from the chaos in stocks, began moving back into equities. The shift created enormous pressure on gold. It was not simply a normal pullback after a strong run. It was a structural outflow, as investors who had crowded into gold for safety began exiting all at once, chasing new opportunities elsewhere. The result was a correction that took much longer to stabilize and even longer to fully reverse. This is the key difference analysts point to when comparing 1973 to today. In 1973, gold was not just overextended, it was overcrowded, sitting at the center of a massive wave of capital that had nowhere else to go, then suddenly did. That combination created a correction, unlike a typical pullback. It created a multi-year rebuilding process. Today's environment does not show that same extreme setup. There is no comparable multi-year stock market collapse that has just ended, sending a flood of capital back out of gold and into equities. This is an important distinction, and it is why most analysts do not view 1973 as the most likely outcome for the current correction. However, it remains an essential reference point because it represents the far edge of what history has shown is possible. Even without an exact match, the 1973 period plays an important role in this analysis. It sets the outer boundary. If the 2008 comparison represents the faster, more optimistic path, then 1973 represents the slower, more difficult path. A reminder that recoveries do not always move in a straight line, and they do not always move quickly, even when the long-term trend remains intact. For investors, this matters more than it might first appear. Relying on a single historical comparison can be dangerous. If someone assumes every correction will resolve as quickly as 2008 did, they may become impatient or overconfident if the recovery takes longer than expected. But by studying 1973 as well, investors gain a more complete picture, one that accounts for both the optimistic scenario and the more demanding one. When these two historical periods are placed side by side, a reasonable range begins to form, based on the size of the current correction and the fact that today's conditions do not fully match the extreme circumstances of 1973. Most analysts studying this pattern lean toward a recovery timeline closer to the 2008 example, perhaps a year and a half, rather than the multi-year path seen in the 1970s. Still, the 1973 period cannot be dismissed entirely. It stands as a disciplined reminder that markets do not owe investors a fast recovery, even when one seems likely. This is the value of studying 50 years of data instead of reacting to a single headline or a single month of price movement. It allows investors to see the full range of outcomes, not just the one that feels most reassuring in the moment. In the next part of this analysis, the focus shifts away from gold entirely and turns to silver, a metal with its own separate history, its own separate timeline, and its own important lessons for anyone trying to understand what comes next. Silver tells a different story than gold, and understanding that difference matters just as much as anything covered so far. Many investors assume gold and silver move together in a simple, matching pattern. When gold falls, silver falls. When gold recovers, silver recovers at the same pace. History shows this assumption is not quite accurate. Silver has its own rhythm, and that rhythm has historically been slower and more demanding than gold's. Looking back across the same 50 years of data, silver's past recoveries reveal a pattern that stretches out much longer than gold's. In some periods, it took silver 2.5 years to return to a previous high and breakthrough. In other periods, it took closer to 4.5 years. These are not small differences. They represent a much longer waiting period than most investors expect, especially those who assume silver simply follows gold on a shorter delay. Why does this happen? Silver behaves differently because it sits at the crossing point of two forces. It is treated as a precious metal, similar to gold, valued for safety and long-term wealth protection. But it is also an industrial metal used in manufacturing, electronics, and other practical applications. This dual identity means silver responds to different pressures at different times, sometimes moving with gold and sometimes lagging behind it, depending on the broader economic environment. This is an important detail for anyone trying to apply the gold recovery timeline directly to silver. Even if gold does return to new highs within a year or a year and a half, following the 2008 pattern, that does not necessarily mean silver will do the same. Based on historical timing, silver's full recovery to old highs could realistically take closer to 3 years, possibly extending into 2028, depending on how this specific cycle unfolds. This does not mean silver investors are left waiting with nothing to watch. There is a more immediate and, in some ways, more useful signal to focus on, one that does not require silver to reach its old highs to be considered meaningful progress. That signal is the $70 to $80 range. Historically, this zone has acted as a significant resistance area, a price level silver has struggled to move above and hold. If silver is able to rise back into this range, and more importantly, hold it as a new support level rather than falling back below it, this would represent a major shift in market structure. It would not mean silver has fully recovered, but it would mean the foundation for the next stage of the recovery is being built. This distinction matters greatly for long-term investors and business professionals who are less interested in short-term price swings and more focused on structural, strategic shifts in the market. Waiting for silver to return all the way to its old highs, somewhere near $120, may not be necessary to recognize that meaningful progress is underway. Reclaiming and holding the $70 to $80 range could serve as an earlier, more practical signal that the recovery is on track. This is a key reason why patience and precise timing matter so much when analyzing silver. Investors who expect silver to move in exact step with gold may become confused or discouraged when the metal takes longer to respond. But investors who understand silver's historical tendency to lag, and who know which specific price levels matter most, are far better equipped to interpret what they are seeing rather than reacting emotionally to a short-term price movement. Silver's story is not one of failure or weakness. It is a story of a different timeline, shaped by its unique role in the economy. It demands its own separate analysis rather than being viewed simply as a smaller, slower version of gold.